thank you all for patiently waiting for this session. I think you've spent a substantial amount of energy during the day with the earlier sessions. I promise you, I mean, the discussion that we had before this session was definitely worthwhile being there if you had been a fly on the wall. Hopefully, we'll be able to carry some of that through here. We've got 20 minutes to start, and then I don't know if we'll have any time for questions, but let's hope we do. So since I don't have to, I can just say Vikram and Vikram here, right? That's a great thought. Let me start with Vikram here. Investment in the retail business or retail brands require, to my mind, some time to build. The business requires some time to build traction adequately. Do investors, do VCs have that frame of time in front of them that allows them to invest in retail, or is it more kind of tech businesses scale up faster and therefore that's what makes sense?
No, we work on a simple principle. We look for a 5 to 6 year time frame for exits. Sometimes we can stay on longer if if there's a substantial outcome happening, maybe in the 7, 8 year time frame. But when we invest, that time we're looking for about, let's say, 6 year kind of a time frame. So during that time, as long as we are able to meet our returns objectives, so we evaluate from that perspective that at the time when we are exiting, who will buy this? Why will they be attracted to this company at that time? Will we get a premium at that time as compared to the market? And why will we get the premium? So we do a lot of exit evaluation. And if it makes sense, over the time frame in terms of our desired returns outcome, we make the investment. So I think, of course, when we look at certain brands, for example, if we see that they're addressing the markets which are pretty sizable, biryani by kilo is an interesting example where, when we first looked at it, people were asking, biryani, you're investing just in biryani as a food category. Is it a, good investment from a VC perspective? People are looking at entire food category. So, it was interesting to see that the largest selling category on Zomato or Swiggy was actually biryani. And, you're talking about 140 crore nation. And we are quite surprised with the kind of biryani that is consumed in this country. And if you actually create a brand in that space where hardly anybody had created a brand, you can actually become number one or even number two in that space. That can actually create a substantial scale for you. So when we actually invested in 2019, they were doing just about, very small, about 1 crore or so revenues. And they scaled up, substantially today to become, I think, in terms of the brand, they're number one in the country. So, if you have a vision to create a sizable business, and if you're in the right space, and if you believe that you can create some differentiation that people appreciate, and if it comes to that category and that's your first name that comes into the mind of the consumer, I think you created something, and that's what, as a VC, you look for. That, when you go to the market to sell that business, anybody would love to buy that business. So that's the way we look at investing, especially when you look at brands.
Sure. Vikram, how about you? I mean, from your perspective, you've invested a lot in companies which are kind of enabling the ecosystem for retail. Do you see a difference between those and the ones which are actually D2C in some form?
Sure. So I would unpack retail a bit. So if you look at retail, there is front-end retail, which is where consumers go to a shop and buy something. It could be apparel, grocery, electronics, anything. Then there is the mid-leg, which is supporting that, which is warehousing, shipping, all that. And then you have the brands, which are basically the products that are manufactured. I think as an investor, as the other Vikram said, is that what matters is value creation going to happen at the end of the journey? And hence capital efficiency, ROCEs, everything come into play. So in retail, although it is like 5-6% margin business in grocery, but what matters is ROCE. And hence DMart or Vedant Fashion, if you look at Command, whatever multiples they want, have been very capital efficient. So an investor could make money. Now in tech, like pulling across discussions what you're having, uh, tech essentially allows non-linearity, right? It also is proven that tech built in India can go global. So for example, in our portfolio, we have a warehouse automation company called Grey Orange Robotics. Started in India, now the tech is here, but all GTM is US and Europe. Built phenomenally well over last 10, 11 years and is like around $100 million or so. And then there are brands. So in my mind, value creation and the cookie cutter for success is different in all these three kinds of businesses. Uh, I might say that tech non-linearity comes sooner. In brands, it's a journey which is a longer journey. So that would be my quick take. Thanks.
Sure. Amar, you've been an entrepreneur for at least a few months, and before that, you've been in a very, very well-funded corporate which got sold for a very rich valuation. Started as a startup, but then kind of grew humongously. What's your take on how VCs view companies in retail?
Well, I think I should start with this line. Very rarely a founder gets to sit between two major funds, and that too on the same side. So thank you. Um, when I actually see the retail space, like Vikram mentioned, there is a very linear model being attributed to that space, and hence the returns on investment is also measured very linearly. I think as long as that thought process continues in the VC circle, then the kind of capital that this industry will attract will also be not as, at least even comparable to what tech attracts. But I see that as an opportunity where retail can become a non-linear business model. And again, like Vikram said, it might not be as fast as a tech can do it. What is happening in this country is the consumers need more um, retailers coming. I mean, the market is so up for international brands coming in. At the same time, the Indian brands also have to step up the game to compete with them. And that cannot happen without capital being deployed. So I can't believe if there was any better time in the past, but now is a great time for Indian retail brands, Indian retailers to really step up the game and start seeing not just in India but beyond the globe. And when that happens, a non-linear model will automatically unfold in front of them. And then this question might not even arise in terms of whether tech would attract more dollars or retail would attract more dollars.
You see this as a time when non-linear growth can actually happen in retail.
I absolutely
for
believe in
brands.
it. In fact, that's what we are also trying to crack. So
Excellent. Vikram, to you, just a question. You've invested obviously in retail companies and brands, some more successful than others, and of course, that's a portfolio that every VC plays. What are some of the qualities or characteristics that you look for? If there's somebody in this room who would be pitching to you, what are some of those filters that you would apply to a business?
So I think as a VC, our first filter is the entrepreneur. Eventually, it's the people who make or break the business. So for us, the team is very fundamental. And then, of course, attached to that is the space they are targeting and the business model that they are thinking about. So the space has to be large enough and there has to be some gap in that space. We are usually okay to invest in a model even if it is number two in the market, because usually number one ends up burning a lot more capital. There's enough space for 2 or 3 players, then you're fine as long as you're investing in the most capital efficient business model. The business model therefore becomes very important. How much capital you are putting in to reach what kind of revenue and profit numbers. So we look at basically broadly these 3 parameters. Within that, of course, there's a lot more detailing behind that. And the founder perspective, of course, we look at their maturity level. Do they understand what they're doing? There is a what part, there is a how part, and then there is a very important part, which is a why part. Why are they doing what they're doing? Because, are they really passionate about solving a problem? Or are they doing it just because they think that it's a good time to raise funds and, you can create valuation. If they're actually doing it only for the valuation game, it becomes very visible once you are actually able to, communicate with them or meet with them a few times. You can actually make out the why part very easily. So for us, why part is very important. And and the fourth factor typically for us is actually whether we can add value in the business. Because, raising capital otherwise, it's a good thing that in today's world, in India, a lot of capital is available. It's good for entrepreneurs. If they really want to drive the valuation game, I think one can find quite a few investors who do not necessarily understand the nuances of, the valuations. So they trust the entrepreneur. And if the entrepreneur just ends up raising capital only for the sake of valuation, maybe they might be able to succeed at that point of time. But I think the chances are if they need to raise more capital, then they might have a challenge.
This is the difference between dumb money and smart money.
Absolutely. So that's why we look at whether we can add value to what they're doing and whether they see that value from us. Because if they see that value from us, then of course they would be willing to accommodate us in their cap table, and therefore they also think of creating value for us. So effectively, if we are creating value for them, they would also think of creating value for us. So, because I've seen many entrepreneurs who just come and say, this is my valuation, take it or leave it. So that, and they're great entrepreneurs. They'll do very well. And I always end up the meeting saying that you guys are great. You will do amazingly well, but for yourself. Your investors probably will not make money. And, I think eventually it's a partnership. It's not about one person makes money because of the other person. Both have to, succeed. So that's why the mutual value admiration is very important.
Excellent. So I have a follow-on question to that. We talked about this earlier. There is a feeling that if you're from the right background, the educational background, IIM, IIT, or Ivy League, it's easier to raise money, and therefore you kind of pass a filter.
Yeah, this question gets asked to me a lot because our name is IvyCap, right? So, and effectively we started with the whole concept of this Indian Ivy League concept, because I think the whole genesis and the foundation of IvyCap was built on this IIT alumni capital that came in as the anchor capital, and that's 20% of our funds across our funds. We raised, today it's all domestic capital that we managed at about 5,000 crores. And 20% of the capital raised is all IIT alumni. And what we believe is that there is a lot of intellectual capital sitting there. But that doesn't mean we will be only investing if you are from an IIT or an IIM. What that means is that behind that capital that we have, there is a lot of support which is sitting from that ecosystem. And that support comes in multiple forms in terms of bringing the right investment opportunities for us, helping us in due diligence when we are making investments, because there's a huge network. We're talking about 500,000 alumni supporting this. And because there's an endowment linkage, part of our carry, which we make as profit as fund managers, we give back to the IITs and IIMs as endowment, which actually creates an emotional connect with all these alumni. And that's the reason they're willing to spend their time without expecting any return in value. And that helps us in due diligence and post-investment. That helps us in actually mentorship, value creation, and even at the time of exits. Because, when you look at the Fortune 500 companies, 2/3 have at least one decision maker coming from this background. That helps us even in exits. So this Ivy League concept for us is about the support system that we've created, rather than shortlisting the entrepreneur.
But some words of hope for the non-Ivy League people?
No, so look, our portfolio, if you look at it, naturally we have about 60% portfolio is IIT alumni. Another 20% is IIM alumni. Remaining 20% comes from other backgrounds.
What's that 20% that you really found exceptional?
One company we invested in recently called Snitch. If you look at the background of that founder, it's like amazing entrepreneur. He has, look at his educational background. He doesn't come from any of these Ivy League and even a proper education system that people would look for. But a brilliant entrepreneur with a very small token investment. He's created a huge business, right? And very profitable business. Never raised capital. And when he wanted to raise the capital, he said, I want to raise it from IvyCap. Because he knows that the support system that is going to come with that capital is going to be huge. So I think if you are solving the problem for the right reason, and if you respect the capital, I think the biggest thing which many people don't understand is don't raise capital just because you want to do a benchmark on your valuation. If you respect that capital, if you know that that capital is a third party capital, but treat it as your own capital, and then really be as capital efficient as possible. In fact, I would love to give money to those entrepreneurs who don't need capital. So effectively, that becomes very important, criteria. So it's not about whether you're from educational background of only IITs or Ivy League. I think it's about how you are as an entrepreneur. And interestingly, the data suggests that if you are from Ivy League institutions, the chances of success are higher. There are 112 unicorns, and I'm told that 72 of them have at least one IIT co-founder.
I think Blume had a report out of their portfolio companies, which kind of also
Yeah,
bears you out on
and
that.
even globally, 1,200 unicorns, and the IIT alumni founded unicorns globally will rank number 4th. So there is, some correlation there, but I think that doesn't mean that those are the only people creating value. But that does suggest that, there is an execution play. Eventually, it's all about execution with, and if you're really hungry about what you're trying to do, you would actually do it for the right reason. And if you're doing it for the right reason, there's a very, very high chance that you'll be successful.
Vikram, I'm going to put a question to you about, Vikram here mentioned about exits. And somebody told me a long time ago that investing in a startup is like going to watch a movie, but you should know where the exits are in case you need to get out, right? VCs invest with exit in mind. Yeah, something on that.
Yeah, so, as Vikram stated, like exits are an important part. Many times, the way it is put across is, should the founder focus on building business or on exits? So the way I think about it is that it's a shared responsibility that both founders and entrepreneurs share when they got married, is that the fund has a fiduciary responsibility to return somebody's money. Many times it's somebody's pension money, it is somebody's invested money or whatever. So there is a fiduciary responsibility. The way we look at exits is that we are in the business of investing behind missionary founders who are creating generational companies. And if I look at India as whole, $100 million plus M&As in India are handful, especially in tech, they are very handful. So the counsel that we have for our founders is that build IPO-able companies. On the path to that, if somebody comes and acquires you, great. But it's always that if you go with a sell-side mandate in the market, the buyer's perception is that, oh, this asset is not doing great, and hence they are selling it. Of course, there is a secondary market, there are reasons to do it, and so on and so forth. I wouldn't get into details. But the counsel to founders who are sitting over here is that if you're, as Vikram was saying, if you know the why, and you know whichever segment I talked about, you are building a business, and you are building it for decades to come, then in my mind, it's a public company. And interestingly, today is a very interesting time that there are not many great companies listed on the public markets in India. Like there are about 4,500 companies. If your market cap is more than 3,000 crores, you are in the top 25% of the market. So that's where India markets are, unlike the US. So this is a great market to build great IPO-able companies. So that's what I would look at exits per se.
Okay. We are running out of time on our session. I know somebody's going to ring the buzzer, but just allow us a couple more interesting closing points. I think, Amar, when you look at it as an entrepreneur, how do you see this market which is evolving and kind of getting split by, particularly in fashion, for instance, you've got large corporates like Reliance, etc., coming in with mega amounts of capital, and then you've got the international brands who have deep pockets, decades of experience, and the brand cachet for the aspirational Indian consumer. And then similar stories in other sectors as well within the consumer retail space. How do you see a startup standing up and standing for itself and kind of building that business in this market?
I actually see that as an opportunity because most of the time, all these biggies, they're too big to actually see in their blind spots. And that's where most of the opportunities actually come from. If you look at any D2C brand, I mean, some of the ones even Vikram was mentioning, right? It's not that there were no players in that category. They found a niche, they built around the niche. And I think as a founder, as an entrepreneur, two things that we have to focus on, right? Your market. Does the market um, have everything the market is looking for, right? There's obviously a gap which can be turned into an opportunity, or very rarely you come across an opportunity that the market doesn't even know it needs it, but it could be a game changer. Very rarely it happens, but most of the time you actually go into the gaps. So your understanding of the market is very important, to a point where what would actually make me win? Why am I even in this game? Right? I'm not doing it because this is a category that is going to attract capital. I'm not in that category because this is a category where I have a exit by some biggies. Like, I don't think any founder starts a journey by saying that, oh, Reliance is going to buy me, or some
I mean, there
other.
was a phase when you were to do an Amazon of India or a Uber of India or whatever.
No, we were taking.
There has been.
I can't speak for those founders, but I believe the thought process in their head was, we can build a custom version of it for this country rather than thinking that Uber is going to buy Ola. Like, I don't think Bhavesh ever thought about that, right? That's one part of the story. The second part of the story is how much we understand our own numbers. Right? We actually talk about two sets of numbers, but I believe there are three sets of numbers. One set is anything about contribution margin, which is most of the time what gets discussed when everything is good. When things go south, that's when you start looking below the contribution margin. And it's a sinusoidal wave, right? As the sentiments in the investment community is all high, everybody is happy with the top line. When it goes down, everybody goes to the bottom line. But there is one more important metric that as an entrepreneur, as a founder, that we should be focusing on is your cash flow. Right? Is your business generating cash flow? Because if you focus on that, these two metrics will take care of themselves. And your cash flow is actually dependent on your understanding of the market. Are you creating the right product for the market? Are you creating the right, whatever, tech, product, service for the right set of the market? I mean, there's a tendency to actually think that we have a billion countries, so my market is this big, but it's not true. Right? Even today, we only have a little over 200 million internet shoppers. As per the latest report, only 40 million over a per capita income of about 10,000. So it's not as big as the population of this country. So you need to really know who is your cohort, what is the gap that you're going after, and then build a model or build a business around it and understand the unit economics literally at every single penny level. Like, if I'm spending this money, is this going to help me grow or is it going to help me survive? That just defines your business. Like, when you get all of this right, I mean, it's not one or the other. It's actually going together. And when you get it right, then the conversations with the investment community would be very straightforward. I don't have to paint a story. The story is in the numbers, and they know the numbers better than anybody else.
Excellent. So, since the buzzer has rung, I'll just request each of you, starting from Vikram there, to have closing remarks, thoughts, one thought that you want to leave the community here with.
Yeah, so like I would leave with two thoughts. Many times we see entrepreneurs bringing in stories of what the investor wants to hear. Please don't do that. When I said missionary founders are those who are solving a problem which they are passionate about, and you have to build it for 10, 20, 30 years, else the journey is going to be boring. So that's one. And second is like one of the themes which we as a panel were very bullish about is building from India for the world, especially in consumer. Like last 20, 30 years, we have seen software being built from India for the world, services being built from India for the world. I think this is the time for India to build consumer products for the world from India. So this is a great time for that. Yeah, so those were the parting marks.
Excellent. Amar?
+1. I'm actually following up on the question you asked, right? A lot of times the question gets asked, if you have a biggie in the category that you're getting in, how are you going to win against them? Or if you don't have a biggie in it, why are you even in this category? I see both as an opportunity. If there is a biggie in the industry, there is a very highly likely that there is uh, a gap that needs to be addressed. The markets are changing, especially in a country like India. The consumer aspirations are changing. And there is always an opportunity to cater to. But going back to Vikram's point, you need to find the why. And the why cannot be capital, why cannot be valuation, why cannot be someone else's story. It has to be your story. And you have to believe in it. I was just telling backstage, I cannot build a brand if I don't believe in it. Right? It's not just marketing, it's not just dollars. I have to believe in it. I have to live it. The second thing is if there is no biggie in it, great opportunity, even greater opportunity. You're going to create a market.
It's going to be an expensive build, though.
It is, but that's where, I mean, if you look at all the most valuable companies today, they created the market. And a lot of people followed. And again, I'm sure the investment community will be able to spot those market creators and will be able to back up. I mean, all these most valuable companies were once backed by VC, so it's not bootstrapped anyway.
Vikram?
So my simple advice to entrepreneurs is don't fall in love with the solution, fall in love with the problem you're solving. And I think there are enough number of problems to be solved out there, and we are just starting. And I think India's story is just going to be very, very exciting. The next decade and the following decade, I'm seeing huge opportunity for entrepreneurs. Pick up the problem that you're really passionate about, and make sure that you do a good job at it. And I think don't get disheartened. Do your research properly before you go to the market. Make sure that you've done validation of the problem you're solving. Is it the right problem to solve? Is it large enough? Can it be solved with the kind of better? Can it be better solved as compared to others? And then once you decided on that, don't worry about the investors rejecting you. And in fact, I tell people that if you raise money in the first investor meeting, you haven't learned anything. But if you raise money in the 11th meeting or 21st meeting, you probably know more than the investor you're meeting in the 21st meeting, because you actually, been asked so many questions in those meetings that you probably have addressed each and everything that mattered.
I think excellent points. And one thing I want to point out to the audience, if you haven't already noticed, the two investors on the panel talked about business and the one entrepreneur on the panel talked about cash flow. And that confluence is, I think, what creates a winning team, a winning combination. We could go on for another half an hour at the very least, if not more, but time's up. Big red letters there. If you have any other questions, please follow through outside the room. But thank you so much for your patience and hearing us, and for this chance to the ET Retail team for us to be here.